Hello everyone, this is Dan Gramza and welcome to dangramza.com Market Studies for Monday, July 28th. What we see here is a fairly strong close on a Friday as we go into the weekend. This implies a continuation of a technical uptrend. It still qualifies for that type of category. A few things I want to point out. We're looking at a daily chart if you haven't seen this before in a candle format. I use what I call behavioral Japanese candle analysis. It's my approach to utilizing information revealed by the candle charts, and it's based on ideas that came to my mind when I first saw this in Tokyo at Bank of America while teaching a different course, not this topic. But let's go back to this. The concept. We're looking for a swing trade, which means you're trying to capture a piece of the volatility in a market. And this, again, is the daily chart. So it's something that lasts 1 to 10 days or so. What happened here, I want to point out, is first, if it's green and it's solid, that's an active buy level. That's a sell level. And down here, these dashed lines means it's something that happened previously. Now, at dangramza.com, you can go back over 10 years and look at how these levels have changed as fundamentals and technical issues came up. So, I want to point a couple things out. One, on Friday, we traded 1 point below that low. Below that red line, and that means that you'd have a sell level. It means a long position would be closed and a short position would be taken. I want to point out to you that short position failed as the market rallied to the upside, so that would be underwater. And as we talk about in the foundation course at dangramza.com, the second part focuses on trade management. So how you manage risk for any position is always critical. And you should understand how much risk you will take in a trade before you ever do the trade. Now, some people would say, aren't you frustrated that it traded 1 point below, took you out of a long position, and put you in a short position, and the market rallied? No, this was a level that was considered significant. And so the issue is, are you following your strategy? And if you have the right risk management, the outcome's under control. Do you have a loss here? Yes. But is it acceptable for your account and the strategy that you're trading? The second thing is, you can always get back into a trade. Now, some people would say, whoa, wait a minute. You're going to buy all-time highs in a market? Sure, provided that we have the right risk management in place. And that has to be determined before any type of trade is initiated. I just wanted to point that out so you get a feel for my thought process as we look at these markets. Now, dollar difference, just to give you the numbers in case you're not familiar with futures, from that buy to sell level, that dollar difference is $1,500 a contract. From this buy level to that sell level, that's $2,200 a contract. Let's check out what happened in the NASDAQ market. It also gave us that positive close, and it traded below the sell level, moved in the direction of that short, but then it failed as the market traded above that. Dollar difference down here between that buy and sell level to provide you with that reference is $2,720 a contract. Dollar difference here, $1,240 a contract. Buyers are here. The expectation is they will continue on Monday, but the Dow does not have the same level of enthusiasm as we saw in the previous indices. Dollar difference, and this is very similar to the S&P, traded just a tick or two below that low, and then it popped up. So that means the sell side here failed. And managing risk is always critical. Another example of that behavior. Dollar difference buy to sell level there is $940 a contract. Again, the expectation is that buyers will follow through. In the Russell, dollar difference here between that sell and buy level, $940 a contract. Buyers are here, but can they follow through? The euro, here's another example where the market traded just a little bit below that, what I felt was an important sell level, and it popped right back up. So that would be underwater. Again, management of risk. Dollar difference here, $950 a contract. What's interesting about these currencies, including our friend Mr. Swissy, is the bias is for a move to the upside. Dollar difference here, excuse me, between the buy and sell level, $1,200 a contract. Over in Mr. Yen, dollar difference buy to sell level there, $362.50. Here we're seeing a market where the selling pressure is still in place. Same thing here for the Aussie dollar. However, be careful. This is approaching levels that we have found buyers before. Dollar difference buy to sell level there, $610 a contract. Over in our friend the British pound, buy to sell level there, $625 a contract. Continued downward pressure would be expected. So these currencies are not marching to the same beat of the drum structurally. So it'll be interesting to see what happens on Monday. Well, dollar difference buy to sell level in the Canadian dollar is $460 a contract. Downward pressure expected, but Bitcoin sideways move is expected in that market. Dollar difference here between that buy and sell level there, that dollar difference is $1,975 a contract. Look for an inside day. Well, when it comes to 10-year notes, buy to sell level, $437.50. It's bouncy. Buyers are here. But do they have a fundamental reason to follow through? Same thing in the bond market. Yes, this is potentially bullish, but are the fundamentals going to support that? Dollar difference here, $847. $43.75 a contract. Again, just to give you a feel for that. Over in gold, continued downward pressure as the anxiety of the market lessens. That's what we're seeing here. This buy to that sell level is $5,600 a contract. Continued downward pressure, unless we see something brewing over the weekend, yes. But be careful here. This is where we found buyers. Silver's in the same boat. Dollar difference, that dash line to that sell level, $3,800 a contract. Again, be careful on the short side. Over here in copper, it traded just a bit below that sell level. Dollar difference, $3,750 a contract. The bias is for a move to the upside. Fundamentally, structurally, it's a neutral zone trade. Look for a sideways move. And in crude oil, the dollar difference sell to buy level in that market, $960 a contract. We have a lot of crude oil out there. Same thing holds true for nat gas, but we are at levels that buyers may be coming back in that market. In soybeans, we have a mixture of things coming out fundamentally for that market. A sideways move is what I'm looking for. Dollar difference buy to sell level $950 a contract. In corn, sideways move is what we're looking for, and in wheat, sideways move is what we're looking for in that market as well. Well, those are my thoughts for today. Thank you for joining me. Look forward to being with you again. In the meantime, take care.